What's up, friends? I thought it'd be fun this week to pull together a video about a real estate investing strategy that is applicable right now in the summer of 2024. This hack could make you the owner of a second home and start generating passive income and equity growth even with interest rates as high as they are. Interest rates have kept most investors on the sidelines right now, but there's a way for some of us small-time investors to get in the door right now, benefiting from current market conditions and not blowing your budget. Let's talk about how to make this a reality. Many of us are sitting on a home right now with an interest rate that's probably below 5%. Maybe your house payment is somewhere between $1,200 to $2,200 a month, depending on when you bought and what your interest rate was when you bought it. That's an average range I see for most folks. Average rental prices in Raleigh are about $1,780 for a 3-bedroom and $2,350 for a 4-bedroom. So you can already see by those averages that the odds of you being able to rent for more than you're paying in a mortgage right now are actually pretty good. Another safe assumption is that you're probably sitting on a decent amount of equity if you bought even more than 2 years ago. There are several ways to tap this for down payment or for financing of a new home. But let's leave that alone for the time being because it's not necessarily a bad idea to keep that equity in the home that you're about to rent. So you can rent it and cover your costs. But how does that help you afford a brand new home when interest rates are so high? This is where the math can get a little bit tricky, but it's important that you see this as a long-term investment and not a short-term income boost. It's possible to get your short-term income boost when interest rates aren't as high as they are right now and if you have a ton of cash to play with. But right now, the safest strategy I'd say is a long-term approach that will benefit you big in the future. So to state the main goal here, it's to buy something within your means while renting out your first home to cover your cost completely. If you're paying $1,500 right now for a mortgage, but you could easily afford a $2,500 payment or even higher, then treat that extra $1,000 of expense as an investment of $1,000 a month if you buy a $400,000 property with only 5% down today. And that same property increases in value by 5% year over year, then you're gaining about $20,000 in appreciation every year. Now, if you're paying for a 7.17% interest rate, which is what it is today, then you're starting with around $2,225 of interest every month, with a total mortgage payment of approximately $3,200. But what if you could find a way to get that interest rate down to around 5.5%? Then you'd be saving about $525 of interest every month, and your mortgage payment would actually be closer to $2,800. In the first scenario, if you paid that much interest for 12 months, you would have been paying out about $27,000 over the course of 1 year. And remember, your equity is only increasing by $20,000 from appreciation. So therefore, you're kind of like $7,000 in the hole. But if you can find a way to get that interest rate down significantly, like closer to 5.5%, then you'd only be paying about $21,000 in interest, drastically reducing your losses. I know it doesn't sound like we're in a winning scenario here yet, but let's remember, interest is amortized over the life of the loan, meaning that it reduces each month you make a payment. And let's not forget that you're also paying principal every month. If you were stuck with that 7.17% interest rate, it would help, but you're still not going to be in the green. That principal gives you an additional $3,700 over the course of the year, but that still leaves you in the hole by about $3,300. But if you were able to get your interest rate down to that 5.5%, now you'd be adding closer to $5,100 of principal every year, giving you a positive of $4,100 just after 1 year. I keep saying it just like it's this simple thing to lower your interest rate down by over 1.5%. But honestly, there's quite a few ways to pull this off if you're wise. With our current 2024 summer market softening quite a bit, there's more inventory out there at play, and yet interest rates are still keeping buyers on the sidelines. This gives you an excellent opportunity to find a great deal and to negotiate with the seller to lower your interest rate for you. If people need to sell right now and they can't get it done quickly or for the price that they want, they are absolutely going to be willing to offer concession. This is true in both the resale market and new construction right now. Every time I've been out to look at new construction recently with a client, in every single situation, the builder was willing to offer some kind of concession in order to lower your interest costs. That could be in the form of a temporary buy down that lasts 2 to 3 years, or it could be a permanent buy down that lasts for the life of the loan. Either way, there are a lot of new construction options out there that you can purchase within your means. There's also quite a bit of resale inventory that's been sitting on the market for weeks. This is a perfect opportunity to get into a great home that's just overpriced for the current market. You can come in low risk with low due diligence on the line and then negotiate with the seller for plenty of concession. Both of these strategies can help you get your interest rate significantly lower and help you make a sound investment call. So let's play this investment strategy out on a numbers level so you can understand why this may be a great opportunity for you. First, you rent your first house and you have zero cost. That home is increasing at a 5% clip year over year, along with your potential other purchase. Let's say hypothetically you gain $20,000 in equity every year on that first home. That includes both your appreciation and the principal that your renter is paying for you. Secondly, let's say you find a new home and can buy down that interest rate to something closer to 5.5%. You'd be increasing on this home by around $24,000 per year in both appreciation and principal paid. That's $20,000 of equity in the first home, $24,000 of equity in the second home. Now you have $44,000 of equity in both homes in just 1 year. Let's play that out over the next 3 years. You have $60,000 of equity in the first home. You have $72,000 of equity in the second home. That's $132,000 of equity in 2 homes in 3 years. If you just stuck with one home, you'd be in the green, but you'd only have about $60,000 of equity. So the question could be phrased, are you willing to take that $1,000 a month and invest it into something that could increase your investment by 360%? Now, worth mentioning, the numbers get a little bit tougher if you decide to purchase a second home that's significantly more expensive than your first home. You're going to need to bring more cash to the table in order to offset some of these monthly costs. Maybe that means you bring a higher down payment or you borrow from the equity on your first home. If you can do this and still cover your obligations with whoever's renting the first home, then this is still totally a feasible strategy. I've talked to past clients sitting on over $100,000 of equity and a 2.75% interest rate. They can potentially pull this off. Otherwise, you may need to make this second purchase well within your means. But do not hesitate just because you can't afford that dream home yet. If you want to get into that dream home someday, then the strategy I mentioned earlier will exponentially increase your time frame in just a few years. Can you invest right now, even with those high interest rates and expensive house prices? Absolutely. If you're in our Raleigh-Durham market and you'd like some help running specific scenarios with your situation, hit me up. My information is in the description below. I'd love to help you make a smart investment decision and to find a great new home. Happy investing, friends, and we'll see you in the next video.